Hi, I'm TK, the retirement guy at 401tk.com, and this is a market review for second quarter 2024. The intended audience of our quarterly market reviews are one of two groups of people. First, retirement plan fiduciaries with a capital F, or retirement plan investors that are looking for a concise quarterly market update. Please note that these quarterly reviews are intended for education purposes only and not intended to be interpreted as investment advice. Now let's jump in. Our first stop each quarter is to provide you with summary results. U.S. equity rose 3.2% over the quarter, with large cap tech stocks leading the way. It's worth pointing out that large cap tech stocks generally fall under what's considered large cap growth stocks. Speaking of large cap growth stocks, on the second bullet, large cap growth continued to outpace large cap value over the quarter and are ahead by a whopping 1,400 basis points year to date. International equities rose to a lesser extent, posting just a 1% gain over the quarter. The broad U.S. fixed income market, for those that are interested in lower risk investments, was relatively flat, returning 0.1% over the quarter. The Fed held rates steady over the quarter as inflation readings continued to persist. Expectations for rate cuts later in the year were also steadily scaled back throughout the quarter, which led to some volatility and uncertainty at the longer end of the curve. Finally, the U.S. labor market remained tight but rose slightly to 4.1% at the end of quarter 2, 2024. After highlighting some of the key summary results, now we'll take a closer look at the three primary investments available within retirement plans. Looking here at U.S.-based stocks, as mentioned a moment ago, the broad U.S. equity market, as measured by the Russell 3000 Index, was up 3.2% for the quarter. The best performing U.S. equity index for the quarter was the Russell 1000 Growth, which you might think of as large cap growth, which you should also think of as the Magnificent Seven. Companies like Amazon, Google, Facebook, Tesla. The Russell 1000 Growth of which returned a positive 8.3% for the quarter. The worst performing U.S. equity index was the Russell 2000 Value, or Small Cap Value Index, returning a negative 3.6% for the quarter. While those are some of the key trends for the U.S. equity markets, in the lower table we'll point out the performance by sector. Information technology, again those large cap growth stocks, the tech companies, had a performance of 13.4% over the quarter, but year to date are up almost 28%, with telecommunication services coming in a near second. Next, we'll point you to the immediately above graph to the upper right called the growth versus value. Here, you'll see how the growth equity indexes have performed as it relates to the value indexes. You'll see that over the most recent 10 plus years, growth has generally outperformed when compared to value. While that's encouraging and it might prompt some investors to want to jump over to a more highly concentrated investment profile in growth stocks, we encourage you to make sure you properly consider diversification. For example, with these Magnificent Seven companies, these tech stocks making up such a large portion of the total value of the U.S. equities market, if there was adverse regulation, as an example, that led to some sort of reduction in performance on tech-based companies, would you be prepared for it? We are not saying that investing in certain equity positions is bad, but be sure to properly consider your own investor profile, time horizon, and your risk that you would like to take before making concentrated investment decisions, and be prepared to lower the concentration to other types of investments in the event something adverse does happen in the marketplace. Next, We'll shift gears to look at overseas or the international equity markets. Looking overseas, the developed international equity returned a negative 0.2% over the quarter, while the emerging market equity posted a positive 5% return. Now, to briefly highlight the difference between the two. The developed market is those economies that have reached a more mature economic cycle. Example might be that they have better access or liquidity to both debt and equity instruments in their economy. Whereas an emerging international economy is one that is working towards becoming a developed market. Some examples of an emerging market would be considered China, India, or Russia. Taking a look at the lower chart where it says international versus domestic, you'll see over the most recent 12 or so years how domestic at the bottom, US-based equities, has performed compared to international equities at the top. Here you'll see that generally speaking, the US domestic equities market has continued to outperform as it relates to the international markets. Also, when you take a look at the upper right chart, developed versus emerging markets, this too will provide the most recent 10, 12 plus years of performance when you look overseas, specifically looking at international developed economies compared to emerging international economies. While in this most recent quarter, the emerging market has posted a positive return of 5%, as we mentioned a moment ago, emerging does not always outperform the developed international equity markets. While there's a wide variety of factors that go into the emerging market having a better performance this most recent quarter, our thoughts are that the reason for the performance is more likely associated with values or the cost to get into those equity positions being significantly lower than what some of the other available investments might be. So it isn't necessarily the case that the emerging markets are performing better. It's just that the current price to get into emerging markets might be enticing some investors to go over to emerging when they would otherwise not be investing in emerging if they weren't as cheap as what they were. After looking at international, now what we're going to do is we're going to shift gears and look at US-based fixed income, or the more conservative, lower risk type of investments. Turning now to US-based fixed income, we're going to first point back to the Fed's decision to keep short-term rates flat this quarter. When you combine that Fed decision with lowering expectations for further rate cuts yet this year, we believe that those two factors together have led to some uncertainty, especially so for the longer-term maturities. As a result, we believe that that's led to some negative returns for the longer duration maturities, which you can see in the upper left chart here on this slide. Also, in terms of sector performance as it relates to fixed income, cash is still king, with cash returning a positive 1.3% for the quarter and high yield corporate coming in a close second at 1.1%. Shifting gears now, what we're looking at is what we consider our kaleidoscope analysis. This is dating back to 2013, so just over 10 years with the most recent year-to-date numbers, but looking at the different type style investments that individuals can invest in within retirement plans. You'll see the top performing style boxes at the top and the worst performing style boxes, the historical numbers and what's happening as of year to date. Most importantly with this chart, we want to highlight that it changes significantly all the time. The leading investment style from the prior year could be completely different than what the investment performance numbers are this year, so this helps to reiterate the importance for diversification.
This is TK talking personal finance, not rocket science. 401tk.com.